This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. Today on the show, I have Dan Collins. Dan was recently named Futures Magazine's new editor-in-chief. Dan was with Futures for a long time, but now he's basically the main man. Our conversation was before he was just named editor-in-chief, and we both get a little conspiratorial in our discussion. I hope you enjoy. I'm going to jump right in here, Dan, and I've got a predicate that I want to outline, and I want you to kind of respond, take it, run with it. So we essentially were exchanging email, and we both were having a similar thought, and you thought, hey, let's have this conversation. So here's the way I see it right now. I see a world where JP Morgan can be fined billions of dollars for essentially raping clients. Investment banks can get bailed out. Warren Buffett can get sweetheart deals. And as long as equities are going up, no one seems to care one iota. At least the masses that maybe don't know what they're doing don't care one iota. However, there seems to be, for the guys, for the world, the styles of strategies that you and I have been involved in, which I think are some of the greatest entrepreneurs, the guys that don't get bailouts, the guys that are taking the risk, and women too, I shall say. So the people that are taking the risk that don't get bailouts, that are developing good strategies, and, you know, they take their lumps and they take their wins. But we've got a situation where it seems like, to me, the major news organizations don't even attempt to hide the bias and the propaganda against the styles of trading and the worlds that you and I occupy. Am I far off?
No, I don't think you are. I mean, I don't want to sound conspiratorial about it. There may be some reasons. There may be reasons that the money has to be kept on going on the equity side to kind of maintain maybe a new bubble, in terms of kind of our fragile economy. In the past, you and I spoke about it, there was just this ignorance, because if you learn about business and a journalist, you learn everything from the perspective of the long-only equity world. Up is good, down is bad. So we saw a lot of ignorance there. But what's gone on at Bloomberg, starting with this July, where they kind of attacked hedge funds.
Why don't you go ahead and outline that piece? Because that was kind of the thrust of our initial contact. Why don't you outline that piece, what they did and how you saw it?
The original piece, or the hedge fund piece in July?
The Bloomberg piece that was talking about Morgan Stanley and the funds. I think that was the one that initially both caught our eye, wasn't it?
Yeah, and what Bloomberg, what they did is basically what was disturbing about it is they talked about the high fee structure, which is 100% correct, but it's a retail investment structure problem. If you're an active manager and someone is offering that through a distribution channel, then you have your fee structure, then that distribution channel is adding their own fee structure, which increases fees and makes things expensive. But that's not unique to managed futures. However, the story kind of presented it as unique to managed futures and didn't distinguish that from what we know is separately managed accounts, which probably constitutes something around 95% of the universe that we look at. So if you look at all the funds by the statistics in the story itself, that represents somewhat like 5%. But they kept on equating it with the larger managed futures universe, which is odd. And there's one other thing that I always want to point out, because they keep on saying, well, this is 2 and 20, 2 and 20. You talk to a lot of managers, and unless you're kind of large, most of them don't get 2 and 20. Most of them negotiate something a little bit lower, especially on the management fee side.
What conclusion do you draw from the piece, ultimately, deep down? Now, don't give me the spin stuff that you got to give if you're on a major, you're on with me and it's just me. There's no one else here. So what's your gut?
What I conclude from it is there's a definite agenda. It's not I'm sorry, I kind of digressed earlier. We have seen ignorance. We have seen stories where people in the mainstream media just don't get alternatives and they talk to people. But this was not simple ignorance. This was in an on purpose attack against a strategy. And we could speculate, but I don't know why. And I mentioned that they attacked hedge funds back in July in Bloomberg Business Week. So it seems to be a coordinated effort against alternatives.
I wonder, like I said at the beginning of my comment, I wonder if it's alternatives or it's attempting to punish in some ways or outline the punishment that will come. Let's say, for example, we are in the middle of another equity bubble. If that equity bubble pops, the strategies that article was criticizing will be the big winners. And it's almost like they're laying the groundwork for, the bad boogie speculator story again. Whereas the reality is, if the masses wanted to look to, people for causes of alarm, it might actually be, groups like the Federal Reserve, not the speculators that occupy the world that you and I are in.
Yeah, and think about it this way. Another disturbing part about the story is that they were comparing it from 2003, from the bottom of the original 2000 bear market forward, which is obviously kind of ridiculous in of itself. But these are alternatives, and you talk about, the story said, well, if you had these dollars in equities, it would have returned X. But, the fact of the matter is very few people have exposure to managed futures. Most of them through a 401k or somewhere else have a large exposure to equity. So that they have that exposure already. So it's almost like recommending they put the rest of their money in equities, and that's just so risky. You saw what happened in 2008. I mean, you're not, it's not whether someone's going to put all their money in this or the other. Most people have this exposure to equities, so they're saying you shouldn't even have this 10 or 20% exposure to managed futures.
It's almost like in a way, too, where not only is it an attack on managed futures, alternatives, trend style trading, black swan protection, it's really an attack on just the intelligence of the average investor, because just as you say, to simply say, just long only, don't look back and trust us. It's almost like don't even think about the black swan. Don't even think about protection that in case things go awry. And clearly we've seen 50% S&P meltdowns in the last 13 years. I think if there was a quote conspiracy or there was an agenda, the agenda seems to be multifaceted.
Yeah, well, I mean, and it's funny. I was talking to Tom O'Donnell, who I believe who was questioning why this was going on. And think about the bottom line right now, that there's so much money. Like I mentioned, most people invest in traditional assets. So if there's so much money to invest, any additional money that goes to alternative is really coming from this traditional investment world. So it's just kind of a net. It represents a net loss to the traditional portfolio. If more retail, and we're seeing the growth of managed futures mutual funds, whether that's good or bad in terms of the fee structure. So the more that happens, the more this goes to the mainstream. The majority of people that simply have the typical 401k menu to work with, anyone who says, yes, give me 10 or 20% into this so I have something that makes money if we have another crash, which a lot of people think may be imminent, it's just a net negative to the traditional world.
Let me throw another angle at this too, and I can't recall all of the details of the story from memory, but Morgan Stanley was involved. It was their fund to funds, essentially. I don't recall. The story went after the strategy and didn't bother to go after the investment bank that without a government bailout would not be existing today. Did not go after the investment bank that had smothered a good strategy idea with massive fees.
That's another direction. That's kind of a pet peeve I have when I hear kind of the arguments in politics and about policy. It's like everyone forgot just how close we were to the edge of a precipice in 2008. Not to defend any political side, but we were in deep, deep problems, and people who kind of oppose any kind of different measure are, have this kind of selective memory that, we're just in some sort of a recession. No, this could have been as bad. And the very, intelligent economists I have spoken to said it would have been just as bad or worse than the Great Depression if the Fed didn't come and take extreme action.
Well, and that's even another different angle. I think the one that I'm looking at is that ultimately, as I said, is the idea that you have a strategy of these alternative strategies, a trend trading strategy, and then you take the quintessential Wall Street investment bank who lathers it with fees and then sells it to the public. And then Bloomberg turns around and the negative aspect of the story is really the strategy. I don't recall the story being about Morgan Stanley and their hand in putting the product together. Meaning you could have a great product. You could have a great investing strategy. And if it gets in the hands of the back office and the MBAs at a typical investment bank, they could turn it into frankly, just a piece of shit. And I don't know how that becomes the strategy's fault.
Yeah, well, it's bigger headwinds, and it's a problem with any retail strategy. And I think, you're going to see we've seen a lot of pushback just, in trading in general, because of technology, electronic trading, the introducing broker network on the future side is challenged because more people can get their own, research and go directly online. It's another washout, and this took me several years, and this is a little bit off the mark, but it demonstrates something. I wrote about the futures industry in the era where all the investment banks were very critical of the exchanges and saying that the floors they're inefficient. They need to go to electronic trading. They need to eliminate the floors. They need to make, trading more efficient to lower the cost. All the time while they're making this argument, you have this OTC world, which is even a more inefficient market where there's not electronic trading, there's not clearing. In fact, it's all done over the phone.
No transparency.
No transparency. So, and there was so much pushback against Dodd-Frank and how it's doing, and so many exemptions. So all the while that they're kind of attacking the regulated futures world, they were operating this kind of inefficient model and, defending it.
Well, not to be too much of a homer either, but clearly there's been enough warts appearing on the futures industry in the last couple of years. I hope those will cease, but it seems like there's enough bad things going around. But ultimately, I think the reason you and I wanted to chat is because is that there is a good strategy in the alternatives world, in the managed futures world, in the trend trading world. And to read one of those articles, if you're the average investor, or perhaps you're even a non-educated, larger institutional investor who is maybe just getting around to the point of looking to investigate this world, the article was a hatchet job.
It is, and the disturbing things, and I'll give you one example is a lot of the columns I've been writing for the Dan Collins Report. I've been cross-posting on the Huffington Post. One of the best responses I got was the one on the criticizing the Bloomberg story in July, where they had this kind of humorous, extremely phallic cover talking about what hedge funds promise and what they actually return. I thought it was kind of funny because there's an element of muckraking, like they were protecting the top 1% who are too stupid to invest their own money. But when I posted the Bloomberg, they did not post a Bloomberg story, which I think a journalist reading would say, yeah, this doesn't seem fair, this doesn't seem balanced. But they wouldn't post that. They wouldn't tell me why. So I don't want to sound too conspiratorial, but
I'll take that. I'll take the other side of that. I have no problem. You could be above the fray. I'll be the guy that's down in the alleyways with the fist fight and the knife fight, Dan. You could stay.
That's the important thing. What I'm saying is, and that's what I talk to when I talk to people in the industry. It's like, boy, it's not anything for me to write these blogs and buy the rumors, sell the facts, my blog in Futures Magazine, because the people there are kind of preaching to the crowd. When I talk to people at CTA Expo and things, it's like, we need to get things out in the general business world, because when something like this comes out, especially for people who are not that educated, they believe it.
Yeah.
We discussed in the past a study done by Yale University, which just said that CTAs were useless, and it kind of questioned why they were still in existence, because they didn't provide any benefit. And the humorous thing about that is that study came out, two humorous things about that. That study came out in October of 2008, near the end of the year, where managed futures was the only strategy, the only investment strategy that earned any profit for the year, and it just knocked it all out of the park while everything else was getting destroyed. And the other humorous part about it is one of the authors of that study came from AIG Financial. The group that
the bailout of all bailouts.
Yeah. So I mean, you couldn't make that up. I mean, you couldn't make up something that ridiculous. Yet here we are 5 years later, and you get this Bloomberg story. So I mean, if you break it down and on the why this is coming out, we do have this movement towards of managed futures mutual funds, for better or worse in terms of structure, which holds out the possibility of more retail people getting access to this. And if you look at the investment world, there's only so much money out there. And through 401ks and other investment strategies, that money is already in the kind of long only equity world. So,
I mean, you're saying that, I think it's the Johnson family at Fidelity. You're saying they would be upset if they lost some of the fat assets that just sit there year after year after year with no skill from any of their managers, just putting this stuff long only to not even beat the index, just to collect fees. You're telling me that those groups would be protective of those assets if they went to some other location?
I think so.
That probably sums up our conversation, really. Hey, Dan, listen, we were just going to have a quick one today and run through this. So I do want people to go back and check out your site. Where is the best place for people to go to check out your work, Dan?
Okay, go directly to the dancollinsreport.com.
Okay. Listen, anytime, quick issues, let's get on the horn and talk stuff. You've got great perspective, and you have, you know where the bodies are buried, so to speak. And you've got you've got a Rolodex, that's second to none. So anyways, I appreciate your time today, Dan.
Thanks, Mike. I'll hope to talk to you again soon.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.